Well, hello there. I suppose you have come to talk about the market. You get to my age, and you see a lot of things come and go. Fads, headlines, a lot of noise. Every so often, someone will come up to me with a worried look and ask, Bill, everything seems so expensive. What am I supposed to do now? I always think back to a story I like about investing. There is a fellow named Mr. Market, your manic depressive business partner. Every day he shows up and offers to buy your share of the business or sell you his. Some days Mr. Market is euphoric, the sun is shining, he feels wonderful, and he names a sky-high price. Other days he is in the depths of despair and will sell his share for pennies on the dollar. The thing is, you do not have to listen to him. His job is to offer prices. Your job is to decide whether they make sense for you. And right now, a lot of people feel like Mr. Market is a little too cheerful for his own good. So, what do we do? The first thing I would say is, do not feel like you have to do anything. People feel this pressure to be constantly active because the market is open. It is like feeling you have to swing at every pit. You wear yourself out and you strike out a lot. The trick is to wait for the pitch. You know, you can hit the one that is in your sweet spot. If it does not come, you keep waiting. There is no rule that says you have to swing. I remember the late 90s, the dot-com years. Everything was a frenzy. New issues, companies with a few words and a dream doubling on the first day. It was exciting, but I could not find anything that made sense at those prices. Valuations were unhinged from reality. So I did not chase them. I started selling some Microsoft shares and diversified. Over time, I sold a lot of Microsoft to spread my investments because even for a founder, concentrating everything in one company is risky. When the bubble burst, many dot-com companies lost 90% or more. I stood there with a more balanced portfolio ready to invest in opportunities that align with long-term growth, including health and clean energy through my foundation. So the first lesson in an overvalued market is this: inaction is a perfectly rational strategy. It is okay to sit and wait, let other folks chase hot stocks. Your job is to preserve capital for opportunities you truly understand. I have always believed in saving like a pessimist, but investing like an optimist, that means preparing for the worst by building reserves, but putting your money to work with confidence in long-term growth. When valuations are sky high, that pessimism in saving keeps you from jumping into overhyped trends. That leads to a question: how do you know what you understand? You have to know your limits, your circle of competence. The size of that circle is not what matters. What matters is knowing exactly where the edge is and never stepping outside it. I have never been much for chasing every new fad outside my expertise. People told me I was missing boats on certain trends. They were right. The change was happening. But if I did not understand how to value something, I stayed away. In software, I can evaluate code and tech ideas and guess where they might be in a decade, put me in front of something completely unrelated. And I am outside my circle. Even in technology, where I have spent my whole career, I see risks when things get frothy. Take AI. It is the biggest technical shift in my lifetime, no doubt. But we are in an AI bubble that looks a lot like the dot-com bubble. Tons of investments will turn out to be dead ends. Companies are popping up everywhere, promising world-changing AI, but not all will survive. That is one reason we have trimmed positions through the foundation and elsewhere, selling down big tech stakes and building cash. It is not panic selling. It is preserving a war chest for when corrections come, so we can deploy capital into undervalued opportunities or causes we care about. The market will always tempt you to step outside your circle. It will dangle stories of transformation and disruption. But investing is not about stories. It is about numbers in durable competitive advantages. And businesses you can understand, businesses you can reasonably expect to be standing and thriving 10 or 20 years from now. In an expensive market, your circle of competence is your anchor. You may not find many bargains there, and that is fine. You will also avoid catastrophic mistakes that come from venturing into territory you do not understand. People get so focused on stock prices flickering on a screen, they forget what a stock is. A stock is not just a ticker symbol or a line on a chart. It is a piece of a business. When you buy a share, you become a part owner. You are buying a slice of its factories, brand, people, and future earnings. If you were buying a local grocery store, you would not do it just because someone said the price might be 10% higher next week. You would look at cash flow, competition, management, and try to figure out what the whole business is worth. That is intrinsic value. We try to estimate what the entire enterprise is worth as if we were buying the whole thing, and then compare that to the price Mr. Market offers us. If the price is substantially below intrinsic value, we'll get interested. That discount is our margin of safety. It is our protection against things going wrong, because things will go wrong. In an overvalued market, you often see the opposite. Prices far above any reasonable estimate of value. The margin of safety vanishes. When there is no margin of safety, you are not investing anymore. You are speculating. You are betting that someone else will come along and pay an even more foolish price than you did. That is a dangerous game. People talk about the stock market as a great creator of wealth, and it is, but the wealth is not created by the market itself. The market is a mechanism for transferring wealth from the impatient to the patient. The impatient investor sees the stock go up and feels he has to buy. Now, he sees it go down and fear takes over. He has to sell now. He is a slave to his emotions and to Mr. Market's daily mood swings. The patient investor is playing a different game. He is not concerned with what the stock will do next week or next month. He is trying to figure out what the business will be worth in 10 years. If he is right about the business, the stock price will eventually follow. Over the long term, the market is a weighing machine that reflects true value. In the short term, it is a voting machine, a popularity contest. In an overvalued market, there are a lot of popular but shallow candidates. Your patience is your greatest weapon. While everyone else is voting, you can sit back and wait for the weighing. I often think about the snowball. Life is like a snowball. The important thing is finding wet snow and a really long hill. The wet snow is the quality of the businesses you invest in The long hill is time. The power of compounding is key. It does not make headlines. It is just a business earning money, reinvesting those earnings, and then earning on the reinvested money. If you own a collection of wonderful businesses, that process keeps going year after year through bull and bear markets. It does not care what Mr. Market is shouting. In an overvalued market, the temptation is to interrupt the snowball, to roll it onto some new hill that looks steeper. That is how people break the snowball and lose the magic of consistent compounding. My advice is to find a few wonderful businesses you can hold for decades. Do not tinker with them too much. Let the snowball roll. The end result after 20 or 30 years will likely be far greater than anything a frantic trader can produce. Remember, to win big, you sometimes need to take big risks, but only calculated ones within your circle. Starting Microsoft was a big risk. Betting on personal computing when it was just an idea, but it was grounded in deep understanding. Today, with AI hype everywhere, those big risks look different. Not every AI startup is the next Microsoft. Many are overvalued dreams. Now, you might be asking, what do I actually buy when everything seems expensive? The first place to look is yourself. The best investment you can ever make is in your own abilities. Improving your skills and earning power is an investment with a guaranteed return. If the market does not offer compelling opportunities, you become the opportunity. Read, learn, widen that circle of competence. When I was young, I was terrified of public speaking, so I took a course that changed my life. Investing in yourself improves the underlying asset. As for specific investments in an expensive market, you often have to look in boring places. The glamorous stocks on the front page are almost always overpriced. The story is too well known, but there are always corners that are overlooked. Old line industrials people think are dinosaurs, or solid companies in temporarily out of favor industries. You have to be a scavenger, not a fashion follower. Focus on simple business models with dependable cash flows. That is how I have preserved wealth, with long-term holdings and steady, essential businesses. Invert your thinking. Instead of asking, what should I buy? Ask, what should I absolutely avoid? In an overvalued market, avoid the popular, the fads, anything that requires a perfect future just for you to break even. Look for businesses that can still do reasonably well, even if the future is bumpy. That is durability. Management matters a lot, especially when prices are high. You want managers who are able and honest, who think like owners. Look at how they allocate capital. Do they buy back shares when they are cheap? Make smart acquisitions, or do they waste money on ego-driven deals? Are they candid about mistakes, or do they only tell you good news? In storms, you want a captain who knows how to steer, not someone who only enjoys calm seas. Let us talk about cash. People sometimes see cash as a drag, and it is true. It does not earn much just sitting there, but cash is not trash. Cash is oxygen. You do not think about it when you have plenty, but When you run out, nothing else matters. Cash is optionality. It lets you act when opportunity appears. In an overvalued market, you should be building cash deliberately. By trimming fully valued positions, you are building a war chest. The market will have sales. It will have panics. When that happens, and Mr. Market is deeply depressed, you want to be one of the few with money to spend. Fear and greed drive markets. But there is a third emotion, just as powerful, envy. In an overvalued market, you see neighbors bragging about a cryptocurrency that doubled or a stock that went to the moon. It is hard to sit on the sidelines. Envy tempts you to abandon your discipline. I have felt it too. You have to fight that feeling. Define your own game. If your game is to find and hold wonderful businesses for the long term, what someone else does in a speculative frenzy is irrelevant. You are playing a different game. When people say the market is overvalued, they usually mean an index, but an index is an average of many companies. Within it, some will be more reasonably priced. Your job is not to judge the entire market. Your job is to sift through companies to find the few still priced sensibly. It is harder work, but that is where opportunities hide. If you are not into picking stocks, low-cost index funds can be a good way to stay invested without making big bets on individual names. Have a trusted advisor in your life. A friend, a spouse, a mentor who understands your thinking, someone who is not afraid to tell you when you are wrong. The investor you must be most wary of is yourself. A calm outside voice is priceless. When prices and emotions run high, history helps too. Live long enough and you see cycles repeat. Dot-com bubble, 2008 crisis, Nifty 50, manias and panics. The details differ, but greed and fear never do. Knowing that is an advantage. It lets you stay cautious when others are reckless and optimistic when others are despondent. Trees do not grow to the sky. Downturns come and go. But over the long run, betting on the resilience of the American and global economy has been a winning strategy. One of the biggest mistakes investors make is trying to time the market. They dream of selling at the very top and buying at the very bottom. It is a fantasy. I have never met anyone who can do it consistently. Timing the market beats timing the market. If you are a long-term investor, you must accept that declines are the price of admission for long-term gains. If you cannot stomach a big drawdown without panic selling, you should choose a more conservative portfolio and accept lower returns. We have covered a lot, but I want to end on what really matters. I still live fairly modestly. I like simple habits. The money I have made is just a way of keeping score. It does not define my life. What matters are relationships, the people you love, the work you find meaningful. Do not let the pursuit of wealth, especially in a tricky market, consume you. The happiest people I know are not necessarily the richest. They are the ones loved by friends and family. the ones doing what they love. Investing is important. It can provide security and opportunity, but it is still just a game. Life is what happens while you are waiting for your investments to compound. So be patient with your investments. Be disciplined. Stick to your principles. But more than anything, be generous with your time, kind to the people around you. Invest in your life, not just your portfolio. That is the ultimate margin of safety. In this AI-driven market frenzy, not every bubble will burst like tulip mania, but many investments will fizzle out. Survive the downturns with purposeful spending, smart habits, and emotional discipline. Thank you for listening. Start saving like a pessimist today. Invest in your skills, build that cash buffer, and stay optimistic for the long haul. Your future wealth depends on it.